Hey traders, Raghee here. Welcome to the top tier outlook for Sunday. Well, for the week of March 18th. Happy Sunday, everybody. We are going to take a look at the way in which we're opening here this morning. I'm not looking for a big gap up. I would like to see a lot of stability near the Friday close. There was a nice, very subtle move off the wick, the low from Friday, and trading around that area would be great. Not putting in a lower low between now and tomorrow would be even better. So again, hope everyone's having a really, really good day, and or I should say afternoon or wherever it is. It's still bright outside here. I do like when we shift time, because usually when I'm doing the show on Sunday evenings, it's almost pitch black. So this is kind of nice. It looks like it's still 2 in the afternoon. All right. So anyways, let's get to it. As always, gang, phone lines are open for your requests. If you have any questions, type them on in. And let's get to it. What do we have going on here on the open? So I'd like to see the previous session close. And this is something that we do each and every morning as we prepare to day trade in the Sector Secrets Mastery. And we just take this nice little manually drawn line. It's just a horizontal line that I've labeled PSC, which stands for previous session close. And we moved out to the close. The close on Friday was 18,063.5. So I'll just move that down. And then now we know where the line of the sand is. In other words, to be up in your position based on Friday's close would be to be north of 18,063.5. Now, that's the bullish hemisphere in relation to Friday's action. And there's a lot of psychology that, especially when you're day trading, leads to higher probability follow through. So, for example, if this were actually Monday morning and not Sunday evening, I'd be taking a look at the S&P, for example, the 5183 and a quarter, 51.83 and a quarter level. And I'm actually just changing this as we're talking. And I would just move that down. If this were Monday morning, this were 9:30 Monday morning, and I see prices just above 51.83 and a quarter, my overall approach to that morning, as long as 51.83 is still support, is to focus on, for the most part, the long side. That's not a setup in and of itself, but one of the challenges, so these are where a lot of times traders struggle with trading. And a lot of the struggle comes from not having confidence in a high probability side of the trade. In other words, when we decide to buy a call, it should not even be a question as to whether we should be short. There should not be any doubt in our mind, based on our analysis, that the follow through is going to be up. That's when you know you have a setup. Because if you're thinking, well, maybe it's good for a put or a call, there is absolutely no setup, and move on. And do this quickly, because if you let your mind linger on a chart, minds are pattern recognizing machines, even if there's not a pattern there. It will find something to do. Move on quickly. All right. So then when you get to a setup and you go, yes, it's a call only. Now you've got the beginning of a setup. Now you've got something, worth digging a little deeper and figuring out. But if at any time you're thinking, could be long, could be short, I'll tell you, we had that issue this past week, right, in the Sector Secrets Mastery. We opened right about the previous session close. And what a mess it was, because we weren't firmly in the bullish camp, or the bullish hemisphere, as I like to call it. We weren't in the bearish hemisphere either. And those are tricky mornings. If you ever find the open right there at the PSC, really makes sense to just maybe tap the brake. So today is one of those days. Now, granted, it's Sunday, right? Well, we'll know a lot more by the time we get to Monday. But for now, this is at that level where it could be very, very tricky. It's almost as if we have a floor, but it's also a tripwire for potential shorts if we get below that level. So we'll go through all the futures contracts, because that's all that's really trading right now. We'll go through all those futures contracts, and we'll look for where those previous session closes are. We'll do the same thing tomorrow for our ETFs and stocks. We could do it all today too. But it's really easy to overall just sort of step back and say, hey, where is that line? Move it. And you get a really nice momentary look at that daily. A lot of folks ask me, Rog, why not automate that? Why not look at this crude oil chart, see it closed on 81 and automate it? How hard could it be? It's not hard at all. And I've thought about it on and off for a very, very long time. And I thought, wait a minute. With as much as I automate, what I try to automate are things that are complicated. Daily price movement ranges, hourly price movement ranges. There is no way we're going to calculate those accurately and quickly in the way that we need them. So automation it is. If I'm looking at the V score, which is the Z score of X number of closes, that's again not something that I want to sit around with a calculator or pen and pencil, pen and paper and do, right? So when there's room for error, right? When it's complicated, or if it's just going to be impossible to do manually, DPMRs, HPMRs, in a quick manner, then I'll automate, right? Because it adds accuracy, it adds speed. But things like the previous session close, it's really easy to lose the overall look of a chart when everything's getting automated. So for me, I like to be able to take a simple little automatically drawn horizontal line that I just leave. Toss leaves that there for me, right? So it's automatically there for me every morning. And then I'm just going to move it. That's it. I like doing that. So don't automate everything, right? If there are certain things that we can still have a nice visceral feel for, do it, right? And I say that as someone who automates a lot. All right, so there's your previous session close. I kind of lingered on that topic because if there's anything that I find that you put to work tomorrow that'll move the needle for you, that's one of the simplest there is, right? Let's go take a look at bonds. And where are we in relation to bonds? Bonds closed at 118.28. All right, so, I really want to leave you all with things that you can put to work the very next day, whether that be analysis, whether that be a watch list, whether that be a particular symbol to focus on, or something as simple as previous session close, right? These do make a difference. And let's see, the close was 118.20. These do make a huge difference in the accuracy and the follow through and the probability. A huge difference. All right, so let's see what else we have here. So I'm just going through the morning open. Again, I should mention this. And if anyone doesn't already know this, on Friday, I did a video very aptly called NASDAQ Buy. So can anyone guess what position I have starting today in the NAS? We are long. We are not long necessarily the micro or the mini futures contracts because those initial margin requirements can be pretty beefy and not everyone wants to take on a highly leveraged product like the NASDAQ or the amount of money it takes to control even just one contract. So what we do oftentimes is we look for ETF alternatives, in this case, QQQ. So I am starting Monday with a long position in QQQ. And it was up marginally, I think, as we closed, but taking advantage of that pullback we saw on OpX. And another thing that I think a lot of you and myself note when we see things like OpX is that gravitational pull to thick, high, right, open interest levels. If you've never thought about how important those levels are, and you don't need to do any fancy calculation, you don't need any fancy software for this. All I'm saying is open up the option chain for whatever symbol you're looking at, even if it's a 0 days to expiration strike. Open it up and say, hey, where is the open interest? And the more open interest that's there, it's almost like a more powerful magnet. It's got that pull, it's got that attraction. So keep that in mind when you're looking at, well, which way could a symbol move? And how could open interest be a part of what's influencing that movement? For me, you might say, okay, Rog, how do I use that? For me, one of the things that I think I used this example on Friday was SMH. I don't mind to get into SMH again, but one of the things that we had noted is that there was a lot more size south of where price was going into OpX. So I was in no rush, even though we hit the daily price movement ranges on the 13th and the 14th, knowing that we have OpX, knowing that we have that tractor beam, as we call it in the sector secrets mastery. It made no sense to get too aggressive on buying SMH because there was still so much size waiting south of current price in terms of open interest, just likely going to drag it lower. Okay, here's an example of where we did not have this problem. And I kind of, it just makes me angry at myself. But Bank of America was unique going into Friday. What was kind of cool about Bank of America is that there was a lot of liquidity at 35 and a lot of liquidity at 37. So 35 and 37. The cool thing was I wanted to buy as close to 35 as possible. I wouldn't mind if price goes to 37. So we knew we were sandwiched, right? There was size, and that was likely going to be the range it was going to be stuck in, which would have suited me right down to the ground because 35 is a potential zone of entry based on the daily price movement range. And by the way, we can continue to do this kind of analysis even if it is not the third Friday of the month, even if it's just sort of garden variety expiration, there's still going to be a little bit of that tractor beam, just not as strong as the tractor beam that develops that third Friday, that OPEX Friday of the month. But here's an example of Bank of America where the size was exactly where we would want it to be. And that was south of price, but at 35, which lined up with the daily price movement range. So these are things that really will help just generally, but even more so going into OPEX. And really my main trade last week was something that I was thinking would have as little impact from OPEX, and that was GLD. It hit an optional target, just sort of fell asleep. I do want to get into it again, but that was pretty much our quick trade on that one. I didn't want it to be as quick trade as it was, but it was a winner, and that's all. It built our account. That's all we want. That incremental, boring account growth. By the way, gang, if you're looking for exciting account growth, remember, excitement is a pendulum. Excitement goes this way and it goes this way, right? So if we can keep that pendulum in a range, that means that with a decent enough win rate, I don't mean a crazy high 100%. That's unicorns and fairy tales, right? We don't want a super high win rate for many, many reasons. I think I've discussed them in Charts and Coffee before. But if we have the likelihood that we can win 6 out of 10 to 7 out of 10 times, which is extremely reasonable and very doable, by the way. Remember that a coin flip is 50-50. If my approach is at least not as good as a coin flip, what am I doing? If my approach does not in any way slightly give me a better result than just flipping a coin, I don't have a strategy. So when I think about 6 to 7 times out of 10, I don't mind incremental growth because I'm going to win more often than I'm losing. And as long as I don't let those losses run away from me, I'm going to grow an account. But it's not about exponential growth. It's not about, hey, I just hit a home run in NVIDIA. Hey, I just hit a home run in SMCI. Very nice. Now what? Now what? Right? That's why we want to find these incremental movers. And that's where things like XLF have been a constant conversation in the top tier outlook, which, by the way, if you want to go into the top tier outlook, anyone who's in the Sector Secrets Mastery, if you want to go in or has the top tier outlook subscription, if you log into the, you know what, let me just do this. I haven't logged in with everybody before in a really long time. And for those who've never seen sort of behind the curtain before, let me show you here real quick. So once you're a member, this is behind the paywall. And what we're going to do is jump on over to first the Sector Secrets Mastery. There's 2 things you get access to with the mastery. One is obviously the room archives and the learning center and the trade review and obviously all the things that come with being a member. But the other thing you get is access to, scroll on down here to the megaphone, and there you've got top tier outlook. It's a different section of the dashboard, but you have automatically access to this when you're a member of the Sector Secrets Mastery. So if you open up the March 11, and I've just been pounding on the table, this is a year of account growth. Someone was saying, yeah, salty Raghee. Yes, where the green meets the gray, which is awesome because it is St. Patrick's Day, and which is perfect for our theme. Stay in the green, where the green meets the gray. I love it. And one of the things that we want to keep an eye on is, again, focusing on the strongest sectors. And we actually have more sectors green And I'm trying to find my favorite green meme. Here we go. Easy being green, it is not. But on a year like 2024, it's a whole lot easier than other years. This is the kind of year where we have broader participation. And in uh, this week's Top Tier Outlook, which will be available Monday morning, in this week's Top Tier Outlook, I go headlong into what needs to participate to keep our confidence high about follow through. Because one of the things a lot of traders tell me is, Rog, how are you so sure? What I hear is, I'm nervous. I don't see the follow through. I keep hearing people calling for tops and that this is the beginning and the top is in and all that stuff. Now realize all those folks who love to pick tops, no one ever calls them on it. No one ever says, hey, pal, you were wrong how many times before you were right? The market climbed up to how many new all-time highs, before we got a little bit of a pullback. And so please be careful of perma anything, perma bulls or perma bears, right? Please be cautious of that. Why am I bullish? Because the evidence on the chart and the macroeconomic evidence and frankly, the 2024 cycle of being an election year all tend to tell us we get a tailwind. That's a beautiful thing to have, unless you're those poor folks who were on that plane with the tailwind that pushed the plane to something like 800 miles an hour or whatever that was. I was reading that. Unbelievable. This isn't that kind of tailwind. We are not going exponential, parabolic, any such thing. But when we get a nice steady tailwind, a lot of times traders struggle to commit to the dip because they're thinking, well, Rog, I'm not sure it's going to keep going. What we do in the mastery, the sector secret, right? The sector secret, which you can check out, by the way, what we're doing at Sector Secrets, plural, sectorsecrets.com. What we do is we crack open something like the S&P and say, hey, what's inside of you, S&P? And we know it's tech, we know it's financials, we know it's healthcare, we know it's energy. We can also crack it open just from the standpoint of looking at the individual stocks. So if you know what's connected, right? If you know what sectors are connected to the index, if you know what stocks are connected to the index, and you see them working in unison, or you see at least the best stocks strong, the best analogy, maybe not the best, but my favorite is to think about, because it is Formula One season, my favorite analogy is to think about cylinders and the motor. And ultimately asking ourselves is, which cylinders, and are they really powerful ones, are firing under the hood, right? So I hope that makes sense. And we're going to continue to look for the Federal Reserve to do what they've said. If Jerome Powell put it out there in 60 minutes, it's not a matter of if, it's just simply a matter of when. And we're probably seeing, Jay, to your point about where we are in June. Yeah, let's go take a look. Yes, I would love to do that. Let's do that right now. So you go to the CME FedWatch tool. If you just Google CME FedWatch, it'll take you right there. March, this meeting coming up this week, not expected to see any movement in rates, but any cues to dovish monetary policy are going to be huge. We're not even expecting May to be a rate cut. But again, any cues that would suggest perhaps that traders are not aligned with what is potentially going to happen. Now, this look in June, this look in June is about as neck and neck as it's been. It certainly doesn't mean we're going to cut. It doesn't mean we're going to hold. It simply means if there is going to be a cut, it's going to be in June. And that center column, 500 to 525, has to increase. Now, if we don't get it in June, all of a sudden, look what's happening. We keep kicking the can is what we see here, right? We're kicking the can now to July. But what I will say is, if Jerome knows that we collectively expect the current target rate of 5.25% to 5.5% to very likely be down at 4.5% to 4.75%, right? We're looking at 2 to 3 rate cuts, maybe more. He's going to have to change our expectations. And for now, whether it's June or whether it's July, we are going to get rate cuts. Here's the other thing. And I know that a lot of folks are asking, Rog, what if we don't? What if we don't get rate cuts? It is all the more important then. Let me go back to the layout. So here's the question everyone's asking. We'll wrap it up here. If we don't get rate cuts, Rog, what about the buy the dip? It's even more important that you follow the structure, that we all follow the structure that's been in place, frankly, since late last year, but definitely been in place for all this year. It's even more important to buy the dip while we can, right? Because rather than saying, oh, the Federal Reserve is going to change your mind, what are we going to do? Short into this? You understand what I'm saying? Even if they don't cut, we have to buy the dip as long as the structure says there's an optimism about a potential rate cut. When that rate cut expectation, if it were just to turn to ash, right? It just poof, up in a cloud of smoke. If that happens, absolutely, there's going to be a pullback. There's going to be a major correction. But it's a whole lot nicer, a whole lot easier to have built your account when the getting was good, right? Build that nice little profit pillow, like we say, in case that pullback comes. I'll give you another example. I remember when I was trading tech stocks, and I had a lot of people saying, "Oh, these stocks are garbage. Why are you trading them?" So that's exactly why I'm trading them. A lot of these companies are not going to be around. This is most certainly a bubble. And anyone who was trading in '01, who had any more than 5 to 10 years experience before '01 happened, knew we were embarking upon a bubble. But nowhere am I getting deducted dollars or percentages, right, by trading a stock that really isn't worth what it's worth. If I can buy low and sell high again and again and again, what do I care? I'm not investing in them. I'm not holding, pets.com or boo. Remember boo.com? I'm not holding those in my investment account. I'm trading them. So don't worry about what's real. Don't worry about what's going to happen. Because eventually, if we get that pullback, do you think any of this was any less real? That's the psychology that's going to hurt you. So all the more important if you're thinking wrong, they may not cut. No problem. Take advantage of the psychology while it's still here. And then we'll deal with whatever comes next. Because at that point, our indicators will shift out of the uptrend. They'll start to go neutral. They'll start to show us that fatigue. We'll get our setups, right? And those happen to be short come July, August, so be it. But for now, buy the dip, gang, and focus on where the relative performance is. All that is laid out in terms of relative performance and even understanding which sectors matter in this upcoming issue of Top Tier Outlook. You'll see that tomorrow. And as always, gang, there we go. Is that profit pillow sitting in cash? BLP asks. Well, remember when we close a trade, that's cash. I don't quite understand the context of your question. Is the profit pillow? What I mean is build your account, right? So if I opened a trade and closed it, yeah, technically it's cash in my account. Exactly. Let's see, TNX. Yeah, it's interesting when I look at the bonds, they're actually pretty upset. ZN, the 10-year, ZB, the long bond, they're not making significantly higher yield moves, but they're certainly not heading lower in yields anymore, which really does tell us bond traders are extremely upset about what? How long it's taking for the Federal Reserve to align with either May, June, whatever it's going to be. The longer it takes, the more the bonds are going to say it's higher for longer, and which is really what it is. And that the concern that bond traders will come back with is you're staying high at the risk of damaging the economy. All right, gang, that is a wrap. We start at 6 p.m. each and every Sunday. We go to about 6:20. I ran over a little bit. No worries. Great to see you all. And I will see you tomorrow for charts and coffee. All right, gang, be good to each other. Enjoy the rest of your evening.